All right, welcome back. Today we're going to be learning the very last concept for depreciation. Okay, this time we're going to be taking a look at what straight line is. Okay. All right, so once again, the 5 components are still going to be necessary, right? We need to have the asset cost, we need to have the estimated useful life, a salvage value, and a date of when we place into service. And last but not least, to know which depreciation method we are working on. Okay. So we're going to be taking a look at the very, very last one, the one that's most commonly used and is the most easiest one, and it's accepted at it's widely used and accepted by IRS. Okay. It's called straight line. Just like its name, you are literally depreciating it in a straight line, okay? Now, what does that mean? Well, let's look at it this way, right? What we're going to do is we're going to take the asset's cost, right? If there's a salvage value, we subtract it out. And what we do is we're going to divide the asset's life evenly, and we're going to divide the total amount of depreciation basis evenly and spread the expense or spread the cost amongst its life. And that's it. So you're going to have a constant number, meaning here for this example, your depreciation expense should equal the same at all times. All right? Straight line, that means every single year, every single month, you're going to be depreciating the asset by the same number over and over and over again. All right? You're depreciating it in a straight line. It's constant. All right? So here are the formulas. So this case, right, you're going to notice it's a mesh between the methods that we learned this week, right? It's going to be a mesh between units of production and double declining. So let's notice this. The first one we have is the depreciation basis is going to be the cost of the asset minus salvage value. We see this from units of production. Okay. Second thing we're going to have is called the depreciation rate, which is going to be 1 over the estimated useful life. All right. And where do we see this? From double declining. Except this time, we're not going to depreciate it twice as much. We're only depreciating it once. Okay. And of course, the depreciation expense, the same thing, depreciation basis times rate. And the other two are also the same, right? Your depreciation, accumulated depreciation is going to be your previous years plus your current year. And of course, your book value will always be standard to be your total asset cost minus your accumulated depreciation. Okay. So once again, let's take a look at our first example here. We have, we bought a machine, okay, that costs $15,000. Salvage value is $2,500. Estimated useful life is 5 years. Number of units it could produce is 10,000, and the date that you place into service is January 1st. Okay. So here you go, depreciation basis, okay, which is the asset cost minus salvage value. So in this case, it's 15,000 minus 2,500 gives us total 12,500. Okay. The rate is going to be 1 over its useful life. So in this case, 1 over 5, 20%. Okay. Now we got to multiply the depreciation basis by the rate to solve for the depreciation expense. In this case, straightforward, 12,500 times 20%, you're going to get 2,500. Okay? and of course the accumulated depreciation for that year, and book value. Book value is 15,000 minus 12 to 500 to give you 12,500. Right? Now, when we solve for the second year, okay, so let's go ahead and solve for the second year. What's going to happen here? So the depreciation basis is going to be
12,005.
correct. What about the rate?
The 20%.
20%. And the depreciation expense?
The 2,500.
2,500. So exactly. What you're going to notice is that once you solve for one, your depreciation basis, the rate, and the expense, they're all going to be the same. The only difference here is that we're going to be calculating our accumulated depreciation and our book value. Those are going to be different. So once again, as we progress through the years, you're going to notice that all three columns are going to stay the same. And this is exactly why I mean by straight line. It's a constant number. You're going to depreciate it for the same amount because at the end of the day, the goal is you're spreading the cost evenly amongst its life. All right? And the best way to do it is figure out what you can depreciate, divide it by its life, and that's it. That's how much you're going to depreciate every either year or month. Okay. And last but not least, right, by year 5, your accumulated depreciation should match your depreciation basis, and your book value should equal salvage value. So once again, this is one of the easiest concepts to learn because once you solve for one or the first year or the second year, every year is going to look the same. Okay? Any questions here?
So in this particular method, the depreciation basis rate and depreciation expense, it's constant. It always stays the same.
Absolutely.
Okay.
Okay. So once again, let's take a look at how we're going to journalize it. Okay. Same thing here. We're going to take our depreciation expense and our accumulated depreciation, and we're going to journalize it for 2,500. Now that's the first year. Okay. Second year, third year, fourth year, fifth year is all going to be identical. Right? So it's going to be hard to tell the difference. The only way that you'll be able to tell that you've depreciated or not is going to be through your ledger.
And we haven't done the ledger yet, right?
No, we haven't done the ledger yet.
So the second year depreciation expense and accumulated depreciation is different though.
Yes, because the accumulated depreciation row right here is where we keep adding, right? That's where you're going to be matching your ledger. Because you're basically solving for the account balance. But as far as the expense, it should be the same every year. That's something that you're not going to be adding together.
So how would you journal on a second year for this when the amounts are different? How are you going to balance that?
What do you mean? What amount is different?
When you journal here on the second year, the depreciation expense is 2,500, but the accumulated depreciation is 5,000.
Okay, so I see what you're saying. Okay, well, in this case, right, I'm just going to, when I journalize this, I'm only recognizing that I need to place 2,500 somewhere, okay? Now, the accumulated depreciation that you solve in your table is what should reflect in your ledger, not your journal, okay? Your journal tells you that, hey, you're going to depreciate your asset, right, by 2,500, and you're going to place another 2,500 in your accumulated depreciation. in your ledger account, which is a list of all of your accounts with their respective account balances, when you journalize for year 2, it should, and you post it into your ledger, you should add up to the 5,000. Okay, so you're gonna have 2 entries. You're gonna have the first entry for the first year for 2,500. Then you're gonna have a second entry for another 2,500 to get a grand total of 5,000. So this right here is your running balance.
Mhm.
It's not what you journalize.
Okay. Okay, thank you.
This is ultimately so then when you can figure out how much you've depreciated in grand total, it helps you solve for the book value to let you know what is the asset cost right now.
Thank you.
All right. So any questions here for journalizing? Remember, we always have to follow that rule where our debits must match our credits. Okay. So once again, we're going to talk about partial years, and partial years does affect how we depreciate our assets. So in this case, right, I may have mentioned that once you solve for the first or second one, right, this is in context where in case you do have a partial years, right, the first number that you solve is not going to be the number that you're going to use every year. It's going to be either a fraction of what you're supposed to be depreciating every year. You need to solve for a second one for the second year because then you'll have a full year's worth of the asset and then you can proceed to depreciate it the same. So the first year, when we have partial years, it's going to be the fraction of what it's supposed to be for the year. Okay? So once again, we have an example here where we have a machine that's worth $10,000. Salvage value is $2,500. Useful life is 5 years. And the date that you place into service is going to be October 18. So in this case, if we place into service as of October 18, we're gonna start depreciating it because it's the end of the month, right? We use less than 50% of it. We're gonna have to assume that we're gonna depreciate it for sure in the month of November and December. Okay, so only 2 months. So let's take a look at here. So in this case, right, let's solve, right? What is my depreciation basis, rate, and expense?
Should be
Se-
10,000.
7,500.
7,500 for the depreciation basis. What about the rate? What's my rate?
Same 20%.
20%. And last but not least, what's my depreciation basis for the year?
Okay, so you're gonna, so the cost of the asset is 10,000. And then the salvage value is the 2,500. So
Yes.
you would subtract the 2,500 from the 10,000,
For the depreciation basis, yes.
then that'll give you 12,005.
No. What's 10,000 minus 250 or 205 or 2005?
10,000 minus 2,500, 7,500.
7,500.
And then you take that for your accumulated depreciation.
No.
No?
Okay, so that's the depreciation basis is the 7,500.
Okay, so then you take the 7,500, the basis, and you minus the 2,500 again.
Why are you minusing 2,500?
It says 10,000 minus 25. Okay, you got the 7,500. Then the depreciation rate. So you saying 1/5 automatically equals the 0.20%?
Yes, it's 0.2. Yes.
So how did you get that? How do
The
you,
the formula is going to be 1 over its estimated useful life.
and the useful life is 5 years. So
Correct?
you take the 1 and divide it into the 5?
Yes.
Hmm.
And what do you get?
I got 0.2,
What is that in terms of percentages?
20%.
Exactly.
Okay. Then you take that 20% and multiply it by the 7,500. Percent times 7,500. Why do I keep getting 7,500? 0.20% times 7,500. Oh, 1,500. Okay. All right, I got it.
Okay. So then that is the depreciation for the whole year. But
That's
how old is my asset?
only 2 months.
It's only 2 months.
I got 250.
Yes. So what we're going to do is we're going to take that 1,500 because in this case, the asset's only 2 months old. Okay? So therefore, I need to find out what 2 divided by 12 is. Well, in this case, in context, it's going to be 0.1667. But wait, we've done this before, right? You could easily just times it by 2 and divide the whole thing by 12. Or you can divide the whole thing by 12 and multiply it by 2. So in this case, right, I'm going to take my expense, right? It's going to be the 20% times the 7,500 to give you 1,500, and you're going to multiply it by the 0.01667, or what we've seen before was multiply by 2, divide by 12, and you should get $250. I only want to know how much is it going to be worth for only 2 months of the depreciation. I want to know what a percentage is. Okay? So in this context, right, I divide the whole thing and I multiply it by 2 because I only want 2 months worth of depreciation to give me a total of $250. Any questions here?
No.
Okay. So same thing here. Now that we solved for our very, very first year, that's when we're going to have to do the standard journal depreciation expense and accumulated depreciation for the $250. Okay. Now that we solved for what it's going to be for the next year, then it's just going to be 1,500 from here on out. Okay. But this is just to show you what happens when you have partial years, that you have to consider that the very first year, you cannot calculate it for the full year because of the way it's placed into service. Okay? Any questions here about depreciation for straight line?
Not yet.
Okay. So now we're going to talk about 11.4. We're going to be talking about amortization. What is amortization? Well, I'll tell you this, okay? Amortization is when we want to change or revalue a intangible asset. Okay? So it's exactly like depreciation, except depreciation is a terminology that we use for fixed assets. That applies here as well. In this case, when we're trying to depreciate intangible assets, we call that amortization. So the methods behind it is identical. Depreciation, amortization, depletion, they're all just fancy terminologies to separate exactly what you're revaluing, okay? Especially when you're representing how we use it. All right, so once again, fixed asset is to depreciation, intangible assets are to amortization, land is to depletion. All right, but at the end of the day, the concept is all the same. We're going to spread its cost, and because we're using it, we need to represent how we use it, right? Because our asset's not going to hold its value over time the more we keep using it. Now, again, what is an intangible asset? Straightforward. It's things that you can't touch, right? Intangible. So things that you own that you can't touch. So an example would be a patent, a copyright, a license, okay? A trademark, any kind of legal right. And once again, what are these types of things, right? Can you touch a license? Can you touch a copyright? Or no, you can touch the paper. Yes, but that's not the idea. The idea is, can you actually touch what it actually does? So in this case, it's like an invisible shield or invisible protection over an idea or an asset, right? In this case, can you touch that invisible field? No, you can't, right? You can touch your idea all you can, but right now it's invisible. So in this case, right, that's what an intangible asset does, and this is exactly why we need to use amortization to represent that this is its life and how we're going to use it throughout the course of a company. Now, here's a few fun facts that you should know. Copyrights, patents, licenses, they all have lifespans of their own. Some of them could be paid for 20 years, some of them could be paid for 2 years, some could be only lasting you 1 year. Or 5, doesn't matter, right? Because it's based on how long you want to protect it. So in this case, right, its life can last anywhere from 1 to even 30, 50, even 100 years. Right? It just depends on how valuable it is, and et cetera, et cetera. Okay. Now, a lot of corporations nowadays, right, they do not want to protect their stuff. So they give permission, or they actually allow other companies to be licensed to have access to this actual patent, okay? And they have to pay a huge fee for this because it's a trade secret, right? So once again, patents, licenses, copyrights, they're all going to be some kind of protective manner, and they're all going to cost a lot of money. And on top of that, it holds some kind of estimated useful life, right? Could be anywhere from 1 to 50 years, right? Now, with that being said, what happens when a patent is purchased is that it should never have a salvage value. Because think about it. If I buy a license, so basically I purchase a license for $10,000, what happens at the end of its life is that it expires, right? You have a time limit. Once it's reached its end of its life, your only option that you have is that you must renew your license. So you must purchase another protective layer on it, another legal right to it, in order for you to have value to it. But at the end of the day, once it reaches the end of its life, it expires and you have to renew it. So that is the reason why it doesn't hold any value, because it expires. Okay? Now, and then every time you renew it, that's where you can determine the more value you put to it, the more money you're going to make it hold value for. But in this case, a patent license or anything like that, it only holds its value for so long when you initiate the very first protective layer on it, right? Especially when it comes to like licenses, patents, and copyrights, right? You're only adding value to the very beginning of its life. Once it expires and it's at the end of its life and you decide to renew its license, then you determine whether it's worth more money and you should add more money to it or not. Okay? So in this case, no salvage value. It ceased to exist because because licenses they expire. Okay? You can only renew it. Okay? Now, for this class, like I've mentioned before, right, a patent could be anywhere from 1 year to 50 years. So what I decided to do is for this class, I want to keep it nice, plain, and simple. Let's just use 15 years, okay? Because it's kind of in between 2 or 1 year, but it's kind of like not many patents are 50 years old. So at least, most patents are like anywhere from 10 to 20 years or something like that. So 15 is the number that we're going to be using, okay? And then last but not least, here's the great thing about amortization. It acts exactly like straight line, okay? That means when we place it in service, right? The day that you place it into service, it activates immediately. So the time that you place it into service is going to start amortizationing the day that you purchase it, okay? But then again, we're going to follow the same rules to spread its cost evenly amongst its asset, by the asset's life, by using straight line. So remember, depreciation, amortization, depletion, they all have the same concept. They just have different terminologies for each type of asset. So once again, fixed assets depreciation, intangible assets are amortization, land is depletion. Okay. So let's go ahead and dive right in, because once again, if amortization acts just like a straight line depreciation, then this is your key component. The only difference here, right, is that your depreciation or basis, since there is no such thing as a salvage value, your automatic assumption is it's going to be the asset cost. Right? Everything else is the same.
Okay, I have a question.
Okay.
The question was, I was thinking it's not related. Maybe, what if the service date falls on the 15th? You know what I mean?
Okay.
Exactly on the 15th.
Oh.
What we do?
So remember, in this case, right, if it falls exactly on the 15th, that is exactly 15 days. All right? So we count each day. So the first is 1 day, right? The second is 2 days. The third is 3 days. Okay? So in context of this, 15 is calculated as the 15th day. Now, if we are calculating it that way, right, that is the beginning of its beginning of the month. So that is definitely more than 50%, right? Because not only are you using it in the beginning of its life, but you're also going to use it at the end of the month as well. So in terms of this way, if it does fall on the 15, you're going to treat it as if you are depreciating that month, because you're not only are including 15 days, which is the 16th through the 30th, but you're also including one extra day, pushing it to 16 days, which is more than 50% of a month.
Right. Thank you.
Mhm. Okay. Any other questions? Okay, so let's go ahead and dive into our example here. I bought a patent, okay, that's worth $20,000. Its estimated useful life, once again, is 15, and the date that we place into service is as of January 5th. So I'm going to be depreciating, or in this case, amortizing for the full year, okay? So in this case, what is my depreciation basis?
20,000.
20,000. What is my rate?
2%. 20%.
This is 1 over 15.
No, over 15. No.
I got 0.06666.
Good. So about 6.5%. Okay. And then what's going to be my depreciation expense?
I got 133.33. Yeah.
Good. So that means every year that I'm going to amortize this asset, it's going to be $1,333.33. Okay. Same thing here, right? It's still going to be the same. Accumulated amortization is going to be the same concept. And then book value, right? If my asset cost me $20,000 and I so far used, or it held its life for a year, right? So now I need to subtract the 1333.33 to get 1866.67. Okay. All right. So as we've mentioned before, if it's identical to straight line, then you're going to notice that the depreciation basis, the rate, and the expense are all going to look the same. The only difference here is that I have to calculate my accumulated depreciation and solve for my book value every year. Okay? Exactly like straight line. You take a number, you're dividing the whole thing by the number of estimated useful life to get a total depreciation expense. Right? So once again, now we're going to be journalizing it. Now, instead of using depreciation expense, we're just going to swap out the word depreciation and we're going to plug in amortization. So in this case, they're identical in journalizing as well, except you're just swapping out terminology. So once again, you're going to have an amortization expense and an accumulated amortization. Right? Any questions here?
No.
Okay. So once again, we got to take a look at straight line and we got to take a look at amortization. They are identical in calculations. The only difference between them is and you have a salvage value for depreciation, for amortization. No, you have no salvage value. Right? Difference between the two is depreciation, you're depreciating that it's a fixed asset or a tangible asset, where amortization is strictly for intangible assets, things that you can't touch, okay? All right. So make sure when you are using or calculating anything here, we need to bring this table out because this is ultimately going to help you solve for your answers. Now also, this is really easy because all you have to do is just plug in your answers, right? If you know what the asset cost is and you know what the estimated useful life is, you just plug everything in. Okay? So let's go ahead and dive right into the exercises. Okay? So we're going to start off with question number 1 here. Okay. So once again, this is going to be chapter 11.3 and 11.4 exercises because they are similar in concept and idea. So let's go ahead and take a look at the first question here. So here you purchase a coffee maker, okay, for $250, okay, with no salvage value, okay. Its estimated useful life is 5 years and can produce up to 25,000 pots, okay. Now, you put this coffee maker into service as of January 12th. Okay. So in this case, what kind of asset did I purchase? Or in this case, what did I buy?
Coffee maker.
Okay. How much did my coffee maker cost me? Or in this case, what's my total asset cost for my coffee maker? $250. What is my salvage value? Nothing. Good. Because there is no salvage value. What is my estimated useful life? How many years?
5 years.
5 years. And last but not least, when did I place it into service?
January 12th.
January 12th.
Good. So in this case, if I am looking at January 12th, when do I actually start depreciating it?
The whole month, January.
Yes, because the assumption is that you're going to be using it more than 50% of the month. So in this case, right, the assumption here is that we depreciate at the end of the year. Okay, so so let's go ahead and solve for my depreciation basis.
250.
250, right? It's going to be your asset cost minus salvage value, which gives me 250. And because we understand that because this is straight line, it's all going to be the same. Okay. What about my rate?
20%.
20%, right? 1 divided by 5 gives me 20%, which we know that this is going to be the same all the way down. Okay. So now let's go ahead and solve for this right here. What is 20% of 250?
$50.
$50, right? And we know, because it's a straight line, that means every year it's going to be $50. Okay. So now let's go ahead and just solve for the accumulated depreciation, okay? So accumulated depreciation for the first year is going to be $50, right? And then now, what should be my book value for year one?
200.
200, okay? What is going to be my accumulated depreciation for the second year? $100, right? Which then brings my book value to be 150, all right? So then what's going to be my depreciation, accumulated depreciation for the third year?
150?
150, all right? Which brings my book value to be
100.
100, all right? Year 4, what's my accumulated depreciation?
200.
200, which will make my book value become
50?
50. All right, then last but not least, what is my accumulated depreciation for year 5?
250.
250, bringing my book value to become 0. Okay, it is that easy. So that's why a lot of people like this. I'm sorry, companies like this because it is that easy. And on top of that, think about it. All corporations are going to have millions and millions of fixed assets. So this is a way that they don't have to keep track of it. This is a way that they can simply calculate it. And here, they don't have to figure out how much they have to depreciate it for that year, that month, that day. As long as you can figure something out, like something as constant as this, it makes sense, right? You don't have to do that much more extra work. You solve for one, you solve for pretty much all of them, right? You're just spreading the cost evenly amongst its life. Okay. So here, there you go. So, next 2 questions is to go ahead and journalize this transaction. So, what should my journal look like for the first year?
Depreciation expense and accumulated depreciation.
Okay, how much it was for my first year?
$50.
$50. Okay. Okay. So then, if I have this idea right here that for depreciation journal for the first year is going to be $50, right? Accumulated depreciation, right? Depreciation expense. What should my journal for the second year look like?
Would it be the same?
It's going to be identical.
Okay, good.
Okay? Any questions? Right?
I do.
All right, what's up?
Okay. The second year, can you go back to that journal again? Okay, so this is similar as what I asked you, right? Um, when the depreciation is different, so you're still gonna go 50. because it's a journal.
Yes.
It's 100. Okay.
Yes. So once again, this column right here for the accumulated depreciation, this is what your ledger will look like.
Okay.
Okay.
Thank you.
We haven't talked about the ledger yet. It's a running account balance, right? We'll talk about this in 2 weeks from now.
Okay. Thank you.
Mhm.
So, in this specific case, well, just to make it clear, for the second year, technically it's only depreciate $50, right?
Yes, every year you're only depreciating it by $50 every year.
That's why is the journal is 50. So
Yes.
that's the way
Yes.
to understand it for Erica.
Okay. So,
Thank you, Nick.
so every year we're going to journalize it the same because we're only depreciating it by $50 every single year. But of course, if you think about it, if I've had this asset for so long, right? If I'm doing it $50 every year, it's going to accumulate, right? It's going to add up together, right? $50 here, $50 there, $50 there. In the ledger is where you're going to be adding up all of those depreciations. Okay. So, yes. So we'll talk about the difference between the journal and the ledger. Like it will become more and more clear when we dive into our fictitious business. Right, so let's go ahead and take a look at another example here. Okay. So here, all right, we purchased a couch for $2,485, okay, which includes all fees, okay, with a salvage value of $150, okay. Its estimated useful life is 7 years, right, because it's furniture. And you put this couch into service as of August 25th. Assume that the adjustments are made at the end of every month. Okay? It's a little complicated now, okay? So let's take a look at this. What did I purchase?
Couch.
We purchased a couch. How much did the couch cost me?
2485.
$2,485. What's the salvage value?
$150.
150. And its estimated useful life? How many years? 7 years. And last but not least, when did we place this into service?
You're gonna count it as September because it's after the 15th, correct?
Correct. Because it's August 25th. That's definitely less than half the month. So therefore, your assumption here is that you are going to depreciate it as of September. Okay? So here, for the first month of depreciation, how are we going to calculate this? So let's go ahead and take one step at a time. So depreciation basis, what is that going to be?
Uh, 0.143?
Depreciation basis?
No, the rate.
Okay. Hold on, let me do the depreciation basis first. So what's the depreciation basis? 2,335. Right? And what do we know about this number?
That's the same. It goes all the way down.
Goes all the way down. Perfect. Okay. And what is the rate again, you said, Nathan?
I got a 0.143.
it should be 0.1428. So in this context, right, we need to round our expenses to the nearest penny. Okay, but we're going to keep the rate the same, or the rate as not rounded, okay? No, what? Wait, no. Let's just keep going. Okay, there you go. And what do we know about the rate?
It's the same thing that would go all the way down.
It's the same thing going all the way down. Now, what is going to be my depreciation expense? So because I have to round my answer to the nearest penny, I'm going to use my equal round. But what is going to be my depreciation expense here?
Is it 333.57?
That's for the whole year. And
That is for the whole year. Correct, Nathan. This is for the whole year.
so you divide that by, I think it's August, right? Divided by 4 months. September, October, November, December. You divide it by 4.
Okay.
83.394.
Okay, so you're solving for the whole year or a partial year. What did I actually ask you to do?
So we're doing depreciation expense for the first year, right?
Am I doing it for the first year?
No, only for 4 months.
Am I doing it for 4 months?
August 25th should be September.
Am I doing it for 4 months?
So you divide by 12 and then multiply by 4
Okay.
because it's 4 months, like Nathan said.
Okay, so you guys are solving for partial years. What did I ask you to solve for the depreciation expense for?
I didn't get the question.
What did I ask you guys to solve the depreciation expense for?
The month, not the year.
Correct. So in this case, what am I going to do it for the month?
So you divide that amount by 12.
Correct. So I'm going to find my formula, D12. Okay, divide the whole thing by 12. And what do we get?
I got 27.79. Probably it's 27.80. Yeah.
Good. $27.80. So then this context, right? Partial years, it doesn't really matter because in this context, I am going to be depreciating it every single month. So I'm going to include that month, and when I reach the end of my months, right? So let's take a look. How many months is 7 months? 7 years.
12 times 7.
12 times 7 gives me
84.
84. So here I'm going to be having this for 84 months. Okay? Because in this case, that's what I'm calculating it. So at the end of the day, right, it doesn't matter when I start because I'm depreciating it by month. So I just have to make sure I count a total of 84 months and depreciate it every single time. Now, just exactly what Nathan said, we're not going to calculate August. So our first month of depreciation is going to start as of September. Okay? So yes, so in this case, this is to teach you that this is another way that businesses can also depreciate. They can depreciate it every single month because at the end of the day, multiply it by 4, you're going to get however much it should be for the whole year. right? Because in this case, right, if I start in September, by the 4th month, I should get a grand total of how much that it should be if I were to depreciate at the end of the year. So, yes, so in this context, right, they all equal the same no matter what at the end of the day. This time, I'm asking you to depreciate it for just the month. Okay, so for the first month, which is going to be September, I'm going to depreciate this for $27.80. Okay. And once again, because we know that this is for the first month, what's going to be my second month of depreciation? Okay. All right, so the last thing I was talking about earlier was, now that we know that this is how much we're going to depreciate for the very, very first month, then what is going to be my depreciation expense for the second month?
It'll be the same, right?
It will be the same because in this context, right, we're looking at how much it's going to cost me every single month. So that is true. That is going to be correct. It's going to be the same every single month. Okay. So once again, we need to focus, like, what is the question that is asking? In this case, I'm asking you to depreciate for the month. So in this case, right, when we go dive down into our journals, I'm going to be very specific about which particular month, okay? So now that we have this squared away, what is going to be my accumulated depreciation for the first month?
I got 27. Would it be the same 2780?
Correct, because it's the first month. You don't have a previous one, okay? So therefore, what is going to be my book value?
I might be wrong on this, but I got 2756.20.
All right, so you added,
Right.
but you added the $300 opposed to just 27. But that's also wrong because you added. So in this case, book value is to represent what does the asset cost me now that I've used it.
Is it 2457.20?
2457.20. That is correct. Okay? As you can see it slowly lowering in value. Okay? So then what is going to be my accumulated depreciation for the second month?
$55.60.
5560. Okay? Which then makes my book value become, or brings my book value to be
2429.40. Okay.
excellent. Okay? So on and so forth. So what's my accumulated depreciation for the month, for the third month?
$82.40.
I got
80,
83. Yeah,
83.4.
83.40. Okay.
Okay.
And then for the book value, I got 240160. Good.
Good. Okay. So what is going to be the depreciation expense for the month of, for the fourth month?
One 1120.
111.20.
And the book value, I got 2373.8. Cool.
Okay. What is the accumulated depreciation for the fifth month?
139. And the book value 2346.
Okay. All right. What is the book value? What is the accumulated depreciation for the sixth month?
166.80.
All right. Which Excel has now recognized my pattern. So it should be, book value should be 2318.20. Okay. Last but not least, what is going to be my accumulated depreciation for the seventh month?
194.60.
Okay. Which then brings my book value to be
2262.60.
22.
I got something wrong here. 2290.40.
Okay. Excellent. So once again, this is because we're doing it by month. Now let's take a look at the questions that I'm going to be asking you. So first thing here is question number 5 says, okay, record the adjustment entry for the month of August, okay, for the year, okay? So if I am going to, for the first year, I want to journalize the depreciation for the month of August, okay? What should my journal look like?
Okay. Wasn't there no depreciation for the month of August?
Okay, so how should my journal look like?
Would it be 0 debit and 0 credit?
All right, in this case, you don't add anything at all. There's no journal that you need to put there because you didn't depreciate and you are correct. So in this case, no
No entry, right?
no entry. Right? Because you're right, we didn't depreciate for the month of August. We depreciated starting the month of September. So that's the question here. How would you journalize this adjustment if you were to do it for September of the first year? How would you journalize the depreciation for the month of September?
Would it be depreciation expense and accumulated expense? No, wait. Depreciation expense and accumulated depreciation.
Mm-hmm.
2780.
Correct. Okay. For the $27.80. Okay. So then question number 7 asks, okay, record the adjustment entry for the first year, assuming that depreciation adjustments entries were done on December 31st, okay, and it was calculated annually. So in this case, I'm asking you if the depreciation or the adjustment was done at the end of the year instead of every month, how would I journalize the end of the first year?
Then just like Nathan said, we multiply 2780 times 4.
Okay. Okay. So we would what would my journal look like? It would look identical, right? You have the depreciation expense and the amortization. But this time, right? Do we need to multiply by 4, or can we just go to the 4th month and be able to know exactly how much depreciation we've collected so far?
That would be easier.
Right. I mean, that's the same thing. 2780 times 4 should give you 11120. Now, that's also the same thing if you were to actually put it in context, right? If my accumulated depreciation, okay, if my accumulated depreciation, my depreciation expense was in fact this times this, and I only want 4 out of 12 months, it should be 111, 119. But in this case, because you could just do it this way too, 111.20, it's only a difference of a penny. It doesn't really matter here because at the end of the day, you're going to end up with a salvage value of 150. So in this case, you could choose to do either or. Okay. Oops, I should leave that there. Okay. You can either calculate it, or you could, since we've done every single month and we're assuming, right, the end of the year, we know we started depreciating as of September, October, November, and December. That's 4 solid months. So in this case, it's going to be 111.20. Right? Because that's how much depreciation I have done for a total of 4 months. Okay. Good. Any questions? So in context of this, right, I'm not going to ask you anything that has to do months, but just be aware, because when we dive into the fictitious business, we will be depreciating. I cannot talk today. We will be depreciating our fixed assets, and I'm going to ask you to depreciate it for the month. Okay, that's our fictitious business. But on the exam, I will ask you for the year, just because make it easier for you guys, okay? All right. Last but not least is going to be an amortization example here. All right. So here we, on January 12th, you decide to purchase a copyright for $2,500, okay? And its useful life is 15 years. All right, so what did I buy?
Copyright.
We bought a copyright. How much was the copyright? How much did it cost? 2,500. Sorry. How much did it cost me? It cost me 2,500, right? Again, this case, there is no salvage value because it expires at the end of its life. So there's nothing that it can hold a value for, right? The value is determined based on how much you keep renewing it for, all right? And then here, estimated useful life, 15. And last but not least, when did we place this asset into service? The 12th of January. So therefore, if we're doing this in context of years, When do we start depreciating?
January.
January, okay? So let's go ahead. Yes, everything says depreciation just because it is depreciation, except the only thing is when we journalize it, it's going to be amortization. Again, these words are, they mean the same thing, but in context, it's just different terminology for different items. So here for the first one, what's my depreciation basis going to be?
2,500.
2,500. And because it's similar to straight line, our assumption is it's going to be the same. Okay? Now here, yes, I'm not going to have you do all 15 years. I only want you to do the first 5 because at the end of the day, they're all going to be the same. So here, my rate is going to be
0.0667.
okay, 0.0. Okay, bunch of 6s and 7s and 1 7. All right, and what do we know about the rate?
Stays the same.
Stays the same all the way down. So in this case, what is going to be my depreciation expense, or sorry, amortization expense for the first year?
I got 166.67.
166.67, and because this is similar to straight line, what is our assumption here?
It'll be the same all the way down.
It's going to be the same all the way down. So only thing that we have to do is solve here is for the accumulated amortization and the book value. So in this case, right, first one's going to be that one because there's no previous amount. So in this case, what's my book value going to be?
2,333.33.
Good, right? What's my accumulated amortization for the second year?
Is it 333.34?
Mm-hmm. Making my book value what's my book value?
2166.66.
Good. All right. So then, what is going to be my accumulated amortization for the third year?
$500.01.
Good. Bring in my book value to be
$1,999.99.
excellent. Okay. 2 more things here. So 2 more years. So what is the accumulated amortization for the fourth year?
666.68.
66668. And what's going to be my depreciation? I'm sorry, book value for year 4?
1833.32.
Okay. And last but not least, what is going to be my accumulated amortization for the fifth year?
sorry.
No worries.
Oh, yeah, 833.35.
And then last but not least, the book value of year 5 should be 166665. Okay. Okay. Good. So once again, straightforward, pretty easy, right? It's easy once you understand the first 3 rows are just going to pretty much be equal to each other, or they just look identical. All right. So last but not least, question number 9 says, how are we going to journalize for the first year? And then question number 10 is going to ask you how to journalize for the second year. So assuming that we are depreciating or amortizing at the end of this December 31st, what should my journal look like?
Depreciation expense and accumulate.
Okay.
No, that's amortization.
What was that, Nathan?
That's amortization expense.
Yes. So remember, in this context, right, it acts just like depreciation, but we need to remember that this is an intangible asset, so we need to just swap the names out. So it's the same exact concept. So amortization expense and accumulated amortization. Okay, that's the only difference there. So instead of depreciation, it's called amortization. And what is going to be the amount for my first year?
I got 166.67.
That's correct.
Okay.
Okay. So then, what should my journal look like for year 2?
The same, but with 333.34. That's the amount.
Not 333.34.
That's right. Nathan explained that.
Once again, right? Because we're just looking at the journal. What happened that year or what happened that month, okay? When we dive into our ledger, that's where that number is going to be, the 300 number. Okay? So once again, when we journalize it at the time of when you are making your adjustment entries, it's going to be for whatever you solved for that month. Accumulated is going to be for the ledger. Excellent. Any question, guys? This is, like I said, this is the one that a lot of corporations like to use because of how easy it is. Plus, think about how many fixed assets, intangible assets, everything that they own. It's going to, give them a lot of stress if they have to think about this. Thinking about, okay, this one has this one has this one. Might as well make it consistent, make it even, and make it easy. So then all you have to do is just, instead of calculating how much it is for this month or how much it is for this year, it's straightforward because you just solve for one number and you keep it constant. Okay? And this is also what IRS approves as well because, once again, IRS, they have to audit your work. So, it's less work for them to look through it and be able to calculate the same way as well. Okay? Any questions?